better as a result of social media presence.
If it doesn't do those three things, then it's on the chopping block.
It's a return on investment discussion.
Welcome to another edition of the Daily Dealer Live. I'm your host, Sam Dark, and back with us today, co-hosting is the car dealership guy, Yossi. What's up? Welcome back.
What is up? Let's go.
Yossi, what are you wearing there? This is an Eagles jersey. Is this this is the win last night? Yeah.
I was saying I went into my closet. I said, let's pick out, an interesting shirt for today's show. I was feeling spicy.
I love it.
And I didn't want to go with the 18-year-old Miami shirt, so I had to come out with the Eagles jersey.
I love it. I love it. Switching it up, changing it up. Today's going to be a great show. Yossi, as a reminder to everybody, joining the live stream. We're live across all CDG social media platforms. Post your comments. We'll bring them into today's show. And Yossi, what a show we have in store for our Daily Dealer Live audience. Coming up today, Ohio auto dealer turned U.S. Senator Bernie Moreno is on to talk all things automotive and government. Also, we've got Steve Greenfield, general partner of Automotive Ventures, here to talk automotive VC. And you remember that Bank of America Car Wars report? Well, we've depended on it. Many have depended on it for a long time. We've got the author of that report here with us today, who's made a career shift. John Murphy will be up shortly, and he'll share more about his latest move. But first, let's dive into today's biggest headlines. All right, first up today, Tesla has proposed a record-shattering, and I have to say this, saying a record-shattering $1 trillion, that's a line directly from Austin Powers, compensation package for CEO Elon Musk, stretching over 10 years and tied to growing the company's market value to at least $8.5 trillion. With Tesla's market value hovering near $1 trillion today, Musk would need to grow it more than eightfold, while also scaling the company's robotaxi business to unlock the payout. If Musk hits the target, his stake in Tesla could rise to 25% or more, cementing his influence over the company far beyond his current position. The package is designed to replace Musk's prior $50 billion plan, which a Delaware court struck down earlier this year. Tesla is still appealing that ruling. Looking ahead, shareholders will vote in November, setting up what amounts to one of the largest corporate bets in history. $1 trillion. Austin Powers. Did you get that, Yossi? Let's go, right? All right, next up today, August was another strong month for the auto market, with SUVs and hybrids continuing to carry the load while sedans and EVs stayed choppy. Toyota leaned on familiar names. RAV4 sales surged 20% year over year. Camry climbed 14%, and Lexus added 12%. Altogether, 225,000 plus vehicles, up double digits from both last year and July. Honda followed a similar script but leaned harder on electrified models, setting a record with nearly 44,000 hybrid and EV sales, or 36% of its mix. Hyundai logged its best August ever at 88,000 units, up 12%, with EV sales soaring 72% year over year. Kia wasn't far behind with 83,000 sales. Carnival, Telluride, and Sportage kept the core lineup hot, while the new EV9 and EV6 also set records. And Ford kept pace too, moving 190,000 units on the strength of SUVs and a 19% lift in EV sales. Subaru's Crosstrek had its best month ever, but softer Outback and Ascent numbers left the brand slightly down year over year. However, Mazda and Volvo both cooled, with refreshed launches not enough to offset the declines in their core lineups. The big takeaway here, momentum is exactly where it's been all year. Core SUVs, crossovers, and hybrids. And next up today in the M&A activity, and you can make sure to check out the buy-sell tracker here at CDG to check up all of the latest buy-sell activity.
CDGbuysell.com.
Yeah,
we need a jingle, right?
A ringtone. Yeah, we need a ringtone. So, Steve,
CDGbuysell.com.
We'll bottle that one and then bring it back over and over. I love it. Steve Napleton Auto Group just picked up Hyundai and Chevrolet of Palatine from Auto Canada. Many have been anticipating an announcement about different Auto Canada divestitures for a while, rebranding them under the Napleton name. That brings the Napleton family's Chicago area footprint to 11 dealerships, with 4 of them now clustered in Palatine. The deal is part of Auto Canada's larger retreat from the U.S. After announcing in July it's selling 13 dealerships across the country. Further out west, the Kendall Auto Group expanded in Idaho with the acquisition of Bronco Motors. So in a prior world, I worked for a Swiss-based insurance company. I worked very closely with Grant Peterson and the entire team at Bronco Motors. It's a 54-year-old family-run business with Hyundai, Nissan, and Infiniti. It's been a staple in the Boise and Nampa area in Idaho for a long time. Grant and his kids are heck of great people. For the owner, it was the first time his family group became a seller rather than a buyer. He'd resisted selling for years, but after working with Kendall on a smaller deal last year, he decided they were the right long-term fit for the rest of the stores. Put it all together, and the theme is clear. Regional family groups like Napleton and Kendall are stepping into opportunities left by big publics and multi-generational families cashing out, tightening their grip on local markets where clustering and scale can deliver a real competitive edge. And on a side note, again, I know Grant Peterson, great family. They ran an incredible business. That's a great legacy for Kendall to pick up. Also a great group out west in the Idaho marketplace. Finally, up today, dealer outlook held steady in Q3, even as profitability and customer traffic slipped, according to a new survey from Cox Automotive. Franchise dealers saw confidence dip slightly while independents ticked up. And while expectations for traffic and profits softened, market outlook for the next 3 months actually improved. Proof that many dealers see opportunities ahead. Additionally, dealers still see the economy, rates, and market conditions as the biggest headwinds, but concern levels are trending lower compared to last quarter. EV sentiment, though, fell to a record low, reflecting anxiety over the federal tax credit expiring September 30th. What's the bottom line here? Well, the mood suggests resilience. Dealers are adjusting operations, keeping an eye on costs, and riding out political and economic swings without losing sight of near-term opportunities. And that is the wrap. That's a wrap on the news for today. So
You're again to the guests.
Yes. Well, let's go right into the guests. All right. First up today, Yossi. This is an exciting guest who will have many opinions on all things economy, politics, and elsewhere. Let's turn to U.S. Senator for the state of Ohio, Senator Bernie Moreno. Welcome to the show, Bernie.
Welcome to the show.
It's good to be here.
Great to have you on. Wow, so many questions to ask you. I want to start right away with just your first 9 months. How have things been for you, or roughly 9 months, I would say, as a senator? Would love to know, what's in your mind and how you recap these first 9 months of your term.
Well, first of all, I'm having a ball. It's an incredible honor to be representing the 12 million people of the state of Ohio. Not in a million years would I think I would be here. I wasn't even born in this country. I was born in South America. I enjoyed my life as a car dealer for 20 plus years, actually 30 plus years. Geez, I'm old. In the retail automotive business. But, we got a lot of stuff done. I mean, we've got a tremendous amount of accomplishments. We got rid of the California emissions exemption. So now it's one federal standard for the whole country. We moved CAFE fines to zero. So no more paying companies paying huge penalties for not meeting CAFE targets. We got rid of the EV subsidies, which were a total disaster. We got rid of the EV mandate. We made auto interest and American-made automobiles deductible. That was my bill. Super proud of that. And that's just in the car business, and we have a lot more to do. But in a short period of time, we've gotten a lot done, which is really why I got here.
Well, Senator, what would you say has been or will be the most impactful of the changes made thus far?
Letting the marketplace dictate the pace of innovation. So I'm not against electric vehicles. I drive one of the cars I have is a hybrid. I don't have a pure EV, but there's nothing wrong with that. If you want to buy a Tesla or a pure electric car, that's your choice. But the government shouldn't interject into that conversation. The government shouldn't say this particular powertrain is better than another powertrain, because it makes the system not work properly. The system works when consumers are telling dealers who tell manufacturers, hey, build this type of car. It'd be like if the government subsidized red cars and then penalized people who bought white cars. It doesn't make any sense whatsoever. And by the way, it's almost as arbitrary.
Mm-hmm. It's definitely refreshing that the administration is pro-business and seeing good or welcome changes being made. Like you said, free market, very, very pro-free market. That's obviously a great thing. Um, I read a lot, and one of the things I've been paying attention to that I want to get your take on is just the overall the macro economy, right? I read this morning something about rate cuts almost being certain at this point. The labor market weakening to pandemic levels, and core inflation still being above 3%. And I just get concerned when I see these things. I wonder, are we at this point where we're going to get into, whether it be a recession or not, but a real big pullback on the economy? How is that going to impact the sector? I'd love to just start high level. Like, how do you feel about the overall macro economy, right? You're doing great things from a legislative perspective, but there's also things that are out of your control. What are the signals you're seeing, and how do you feel about the overall health of the macro economy right now?
Well, you got to dive a little bit deeper into the numbers. So if you look at the employment picture, you're looking at the employment numbers for American-born citizens massively increased, almost 2 million new jobs for American-born jobs. Foreign-born jobs are down about 1.6 million. So that's a result of deportations, of much stricter border control. That's net positive for the country. You also have a massive change from public sector employment to private sector employment. During the 4 years of Biden, when the Democrats were in charge, the government grew dramatically. We've trimmed the federal workforce, just the federal workforce, almost 500,000 jobs. So you got to factor in, when you're looking at the top number, what's driving that number below it. And that's exactly what we wanted. We wanted more private sector employment, more American-born employment, less foreign-born employment, and less government employment. So you're seeing that. But look, our policies are very straightforward. It really comes down to the following. You want to have a tax environment that encourages growth, and we did that in the One Big Beautiful Bill. We now have total and complete certainty on taxes, full depreciation of new equipment, full depreciation of new factories, no tax on tips, no tax on overtime, total certainty. All those things, except for the tips and overtime, are permanent, which is a big deal. Second is tariff policy. We've pretty much done the tariffs that needed to be done. We have a deal with the EU, with Japan, South Korea. We're going to get the Mexico-Canada deal done. That's a big change, that now we've reset the tariff table. And then the third component of that is huge unleashing of American energy. Energy is the underlying cost of a lot of things. So we've driven down the cost of energy in a big way by unleashing domestic energy production. And the fourth one is good workforce policies. So encouraging more people to get skilled up and trained and not be able to be dependent on the government without having some work requirement. So those are the policies that we put in place. And we also have, Yossi, by the way, almost 10 to 15 trillion dollars in new investment commitments to America coming in over the next 3 years, which will pay massive dividends.
So, Senator, again, so the administration has made tremendous progress in a very short period of time, and I totally give all the credit. But I'm mentioning these things because, like I said, there's still other parts of the economy that I'm observing and get me concerned. And so my second question, my follow-up to the first one would be, you spoke about employment, and one of the promises by the administration initially was, to curb illegal immigration and to really focus on, employment. There's too many details for me to dissect on right now, but you mentioned American-born employment. Now, do you think your constituents, do they really know the impact of, you mentioned that American-born employment is rising, but yet employment has declined. I think the Bureau of Labor Statistics put out their revision for June non-farm payrolls, which was actually a negative print, the first one since 2021. And so is that ultimately, where are we headed? Are we headed for short-term pain for long-term gain for the country? Are you concerned about a short-term blip, recession, pullback, more unaffordability for the consumer? What do you think about this entire situation?
Well, the first problem we have is that the BLS numbers have been a mess. As you know, these are based on surveys. The response rate on these surveys has been very low. So there's maybe some politicization of the numbers. So we're going to get to the bottom of what the numbers are. But look, here's the fundamental piece that we're trying to do. We want more opportunity for American-born workers, less reliant on foreign-born workers, less government employees, and more private sector employees. And we're doing that. And I'd push back that employment has dropped. It hasn't grown overall top line as much as we would want to. Again, we got to see those numbers are real. But when you dig into it, it's doing exactly what we wanted it to do. More opportunities for Americans, less importation of low-skill, low-wage workers, which is good for Americans. And Yossi, the number you should really be focusing on is real wage growth, which is the increase in your wages versus inflation. And we haven't about 5% annualized real wage growth. That means your paycheck is going further. That's actually the most important metric of all, more important than inflation or anything else. Let me just say one more thing, and you hit on it a little bit. We have a guy who's an inspiration to every incompetent leader on earth, which is Jerome Powell at the Fed. This guy's a total and complete disaster. He's keeping our interest rates artificially high by about 2%. So we should see at least a 2% drop in the central bank rate, and that will make a big difference as well. That's the last piece of the equation that's holding us back.
On that note, last time we had the COVID interest rate cut, right? We went into a really big inflation spiral. Is this a concern for you, for the administration, that if we're going to drop rates, which almost seems inevitable at this point to some extent, whether it's 25 bips, 50 bips or more, who knows what's going to happen? Are you concerned about us entering this phase of inflation again, as we all experienced over, in the early 2020s, 2021? What do you think about that?
Well, it should be 200 basis points, by the way, not 25. We need to get down at least 200 basis points. That's where it should be based on where our inflation is looking like.
It should be, but it's not. That doesn't seem, at least based on all the, Goldman Sachs or all the reports out there, that doesn't seem like it's very realistic. Or JP Morgan, they said like 25 to 50 bips is what may happen. Again, it's all speculation. No one really knows.
Yeah, I'm just telling you what I think should happen. And let me tell you why, because we're actually doing something that we haven't done here in Washington, D.C. in decades. We're actually curbing spending. So we're dropping the amount of fiscal stimulus into the economy. What happened during COVID was the exact opposite. You had a generational, historic level of government spending that got unleashed. I'll give you a stat that will blow your mind, Yossi. We used to take about $4.5 trillion to run the federal government in 2019. $4.5 trillion, more or less, to run the federal government. That number got to $7.1 trillion by 2024. That is an absurd increase in federal spending. And when you do that, that's what's inflationary. And then on top of that, they had regulation on top of regulation, which made it harder for productive employment, for producers to generate economic activity. So they're doing everything possible to stifle supply while raising demand. So we're doing the exact opposite of that. We're unleashing American energy, lowering energy pricing, dramatically less regulation, lower interest rates is what should follow. It's just that we have a guy who wants to be a politician leading the Fed instead of an actual economist. But hopefully that changes very, very soon.
Mm-hmm. Bernie, something that's more tangential and unrelated to auto or semi-related, but when you think about just the geopolitical state of the world, we've sort of moving into this like multipolar world, right? China has clearly risen over the past couple of decades. They just had that crazy military parade, which I'm sure, many people listening here got a chance to witness and just watch a little bit. And, you see that and it's, you can't help but wonder, right? What is the future of our country? Like, what is that going to look like? How will our daily lives be impacted? When you see something like that, you think about the future of America, just globalization, deglobalization, right? We rely on China still for, manufacturing, of course, Taiwan with all the chips. This is more of, again, I don't have a specific question here. I'm just sharing with you my like deep down thoughts that go through my head. When you see stuff like that, does it concern you for the future of our country, or what goes through your mind as a senator?
Well, it reinforces the idea that we made a huge mistake 25 years ago when we normalized trade relations with China. We basically built that Chinese military that you saw in that parade was built by American CEOs that went in there chasing cheap labor and built their economy. Consumers that buy cheap Chinese goods to save a few bucks, built that Chinese economy, politicians that encouraged U.S. companies by giving them actual incentives to go out and do business with China. So what's the answer? We got to be self-sufficient here in America. We got to be self-sufficient in the industries that matter: steel, pharmaceuticals, PPE, energy. We have to make certain that we have the industrial capacity here in the United States. We got to make things here in America. 25 years ago, China had no idea how to make a pencil. Today, most of the manufacturing equipment and manufacturing technology exists only in China. That's a huge threat. The good news is President Trump understands this and is working overtime in a very short period to undo all these bad things that we've done. We have to focus much more in the Western Hemisphere. We should build a Western Hemispheric alliance. I call it looking up and down instead of left to right, thinking about what we can do here from the tip of Argentina to the tip of Canada and create a Western European alliance where we have a lot more opportunities. We have a shared heritage, a shared culture, and rely dramatically less on Asia and allow Europe the space it needs to defend and take care of itself.
Well said. Sam, I could ask 10 other questions, but I'll give you an opportunity.
Yeah. So, Senator, it's interesting when you think about the auto industry and you think about our dealers that are listening to this show today. What advice would you give as you think about the next 6 months, the next 12 months in automotive? How do dealers win in this, the tariff environment, the potentially decreasing interest rate environment that's coming up over the next 3 to 6 months? From your perspective as an ex-dealer, you've got that insight. What advice would you give to dealers, business owners looking to potentially either expand, consolidate, sell? How do you win over the next 3 to 6 months?
Well, first of all, the fundamentals always matter. There's fundamentals that stick with you no matter what you got. You need velocity in used cars. Make sure that you order your new car inventory the right way. You stock the right cars. You take incredible care of your clients. And you do that by taking incredible care of your team. Make sure you hire really great, competent people. Don't be afraid to fire when it's somebody who's not fitting inside your culture. These are the things that really, really matter. What I would say is how to navigate the next almost 30 days. If you have an electric vehicle in your inventory, get rid of that thing. That thing needs to be gone by September 30th. Now, we did do something that is very dealer friendly in Treasury. You can, if you have a signed purchase and sale agreement with an actual deposit, and you have that by September 30th, even if the car comes in after September 30th, the $7,500 incentive will apply. But make sure you cross all your T's and dot all your I's. Don't be left behind eating that incentive yourself. So that's the most important thing. Clear the decks on EVs. Make sure that you do that. I'm sure most dealers already have those plans in place. Look for opportunities to use AI. AI is going to change the dealer landscape quite a bit, not just on acquisition, but on communicating with customers, on whether it's service appointments. I see it as a tool to help assist, especially BDCs. Make sure you're not on the bleeding edge of that, but make sure you don't get left behind. Look, again, I'll just repeat, fundamentals, fundamentals, fundamentals. But I say everywhere I go, Sam and Yossi, I am incredibly bullish on the retail automotive business. They've said, when I say they, the so-called experts said that this model is broken and going to die. They've been saying that for 40 to 50 years. Car dealerships are going to thrive in the future. They're the greatest entrepreneurs in the country. And, I actually sorely miss the retail automotive business quite a bit. It's one of the greatest businesses you can be in.
What's the flip side of the EV demand, do you think? As rebates go away, it's interesting. Talk about how, the rebate still qualifies if you have a signed deal prior to the deadline. We talked about that. Aaron Ziegler did on our team call this morning with our team. So they know that they're running towards that. There is demand right now. There's urgency. On the other side of this, what's EV demand going to look like? And then I've got a follow-up question about China and what they're producing in EVs.
It'll probably settle in somewhere in the single digits, probably 5, 6, 7% is where that's a baseline normal rate. Look, hybrids are a much better alternative. I think you're going to see car companies doing a lot more around whether it's full plug-in hybrid or regular hybrid. I think you're going to see a lot more of that. But here's the important part. The customer gets to decide. The customers are the ones that give us that signal. They make decisions every day in the showroom. That's why car companies should listen to their dealers. The dealers are talking to their customers every single day. Build what customers want. That has been the mantra of the auto business. That's what's made it successful. That's what we should keep doing. But pure 100% EVs, probably somewhere around 5 or 6% would be my guess. And I still hold that I think the industry settles in at a 16 million SAR, which is what I said back in April in the New York Auto Show. The S&P Global people who are experts that spend all day studying macro trends and reading all kinds of reports said the industry is going to be at 11 or 12 million. I can't imagine being that wrong and yet continuing to make a big salary like these guys do.
Yeah. So shifting to China a little bit, Senator, it's interesting. A lot of interesting technology as it relates to EV vehicles and technology around EVs is coming out of China, and they're just putting their inventory all over the world. So it's from Mexico to Australia. India is a big market right now that is kind of a dumping ground for these EVs. How do you look at it when you advise President Trump and the administration? How do you look at that, where our economy is protected from those vehicles for now, but as that develops and it becomes better and better, is there a point where we need to open our doors to it and compete with it to stay current with it? What's your take on that, protecting the U.S. economy from the flood of Chinese imports, but technology that is quickly and rapidly evolving?
Yeah, as far as I'm concerned, we'll never let Chinese cars into the American marketplace. I went to Mexico, encouraged them to do the same thing, kick the Chinese out of Mexico. It's a cancer on their automotive sector. I've said the same thing. The EU should be mirroring our policies when it comes to China. These are cars that are designed not for domestic consumption, but for the destruction of Western auto companies. And then they want to dominate this industry for a reason, because these are good jobs that take up a lot of a country's GDP. So we will never allow Chinese cars in this market. We won't allow them to plug into our telecommunications infrastructure. That's why we have the connected car rule. And one of the things that we did in this trade deal, and it hasn't been talked about enough, is the acceptance of each other's standards. So with the EU, if you make a C-Class Mercedes for Germany, that same car can be sold in Ohio, California. That's a big deal. We're doing the same thing. We got that done with Colombia, and we're doing the same thing with Japan and South Korea. So we want to have a mutual harmonization of standards at some point, but accepting each other's at this point really matters. And we want to box out China, and we're going to do that because we will be the ones that develop the next level of technology, which is what consumers want.
So do you think in the race to evolving that technology, the U.S. gets there well before China does? Because it is interesting. Yossi made that comment about this military parade and kind of this band of, it was a crazy picture that we saw with Putin and the president of North Korea. And it was like a cast of characters from X-Men almost watching them parade in this military parade. The global environment is becoming more dangerous and a little bit less friendly to the United States. At some point, do we need to compete with that technology? Are we okay with it?
Yeah, Sam, the technology that wins is a technology that consumers want. Yeah. China is singularly focused on EVs. When I just said to you, the market's going to settle in at 5%, 95% of consumers are saying that's not for me. So what we're going to do is listen to consumers, let the marketplace develop naturally, and that's how we win. The Chinese are terrible at making hybrids or ICE cars. It's not what they do, and that's what consumers want. So if the Western world, the Americas, EU, Australia, South Korea, Japan, the great alliances that make up 50, 60% of the world's GDP are on one page, and you isolate the Chinese, they can't make money. They have like 90 different Chinese brands that are all supported by the government. They all race to the bottom to see who can make the cheapest cars and then ultimately all go out of business. That's not a good sustaining model. And I think we're going to cripple the Chinese auto industry and not play their game. What Biden was doing is playing their game. He was crippling where we were good in the ICE world, in the hybrid world, and adopting their standard and then having the U.S. taxpayers pay for that right by $7,500 a pop. We're just not going to do that. So we don't need to do that. What made America successful is that we were a consumer-driven market. We built and designed products customers wanted, not what politicians wanted. So not what was politically correct. If somebody wants a 1,200 horsepower car, then make 1,200 horsepower cars. Don't say that, well, that's bad for the environment, et cetera. I can't wait to see what happens to all these Chinese batteries when these cars are littered all over the globe, completely useless, and there's no place
Yeah.
to dispose of these disasters.
Yeah.
Senator,
Yeah.
we appreciate your generosity with your time. Just final question. What are your plans for any collaboration with the dealer community, auto associations, NADA over the coming months? Can you tell us a little bit what you have on the horizon in the works?
Yeah, we work with them all the time, whether it's NADA or the Auto Alliance. We communicate on a regular basis. NADA has a fly-in here in DC next week. We'll be speaking at that event. We're doing some events with car companies as well. We'll be at the NADA event in February, NADA convention in February. So really advocating for the auto industry. This industry is really, really important to our country. It's really important to me, and I'll keep advocating to make certain that we make this industry successful. And I just want one quick thing that you didn't talk about when you talked about auto sales. You guys should do this chart. Take a look at the percentage of automobiles sold in this country, made in this country, and you'll see a massive increase in American-made automobiles. That's phenomenal for this country.
Senator,
Senator
thanks
Bernie
for joining,
Moreno.
and thanks for all you're doing for the American people, for the industry. We really appreciate it. So
Thank
thanks,
you.
Thanks
I
again for
appreciate it,
coming on.
guys.
Thanks for being here. It's an interesting
I got that-
conversation. So much
yeah.
to talk about, Yossi.
I got the juices flowing for sure.
Yeah.
So it goes way beyond just the auto industry, just the impact of all these things. It's like I said, the biggest thing for me was I understand how positive it is to have more American born employment, of course, right? It's our
Yeah.
country, but at the same time, if the constituents are demanding this, are they willing to potentially have it come at the expense of short-term revenues and profits, right? That just like it's math. So, and these are the things I think about, like, what are we asking for? What are the repercussions? And where are we headed next, ultimately? Or the impact on the industry and following these jobs numbers. I don't know. I mean, I assume these numbers are the numbers. Of course, they were revised down twice, which clearly tells you there's big errors. So I do agree with him there. But it's a lot of question marks, right? What's next, and this upcoming year, what we're going to see from just an affordability perspective, a demand perspective, and SAR, which he was correct. He did predict to be on track for roughly 16 million, so he was correct with his prediction there, more or less.
And his opponents were projecting 11 million, so he won the right side of that. Well, let's talk support of the show. Lot Links. Get the best possible market advantage on every vehicle transaction, optimize operations, and boost profits using artificial intelligence and machine learning. Learn more at lotlinks.com. You can also go ahead and scan the QR code for more information on that as well. We appreciate Lotlinks for supporting the content in today's show and bringing it to you today.
Thank you, Lotlinks.
Thank you, Lotlinks. All right, well, let's transition directly into our next guest. Next up, general partner of Automotive Ventures, Steve Greenfield. Welcome to the show.
Hey, guys. Good to see you.
Welcome, Steve.
Good to see you guys.
Steve, glad to have you on.
I'm honored, and you squeezed me between two really great presenters, so I'll try to live up to their standards here.
No, we're doing a world tour today. We got geopolitics, we got venture capital, auto tech. Then we're going to soon have OEMs. Yeah, I know, right? Steve, for those unfamiliar with you, can you just give a brief intro about who you are, what you do?
Sure. 25 years in auto. Spent 10 years at Manheim, the largest auction company in the world. Spent 5 years at Auto Trader, which at that point was the largest classified site in the world, and then a couple of years at TrueCar on the West Coast. And then 5 years ago, decided to do a pretty dramatic pivot with my career, started a venture capital firm, Automotive Ventures. And we're now on our third fund. We've made 45 investments in 5 years. And we're hunting the globe for really talented entrepreneurs who are trying to solve really, really big problems in the automotive and more broadly across the mobility spectrum.
Excellent. Steve, can you give us an update on just the state of auto tech venture capital? Lots of dealers over the past couple of years have invested in, automotive startups, things that they're using in their own stores or benefiting them. Some have even actually launched their own auto tech startups from within dealerships. We'll talk about that as well. Can you start with just an overview of the state of auto tech?
Yeah, so I think you've characterized it quite nicely. I think the valuations are down pretty considerably over the three or four last years. which isn't great if you're a founder. It's been a hard time to raise capital over the last like 18 months. So that isn't getting any easier yet. And I think until the IPO markets open up, there's a cascading effect back to earlier stage stuff. But to your point, I'm amazed. Like even this morning, I talked to a dealer who's got a couple of stores, and he's got software he's built internally that he wants to take to other dealers. The barriers to entry for software development are so low now. And it's amazing now. You know, the three of us over a weekend, we could spin up a brand new software product and start selling it to dealers. So I think we are on the cusp of I'm sure we'll talk about AI, but even outside of AI, we're on the cusp of, you know, tremendous innovation where 10 years ago, it was expensive and hard. You had to hire a CTO, et cetera. Now it's really, we've democratized software development, which is going to mean that we're going to see a wave of new innovators helping dealers solve some of their biggest pain points.
Well, Steve, you've been on the forefront of a lot of innovation in the industry. You didn't mention it, and I think it's important, but you worked on some of the biggest M&A and acquisitions in our industry, right? Auto Trader, KBB, I believe, and you name a bunch of other names. What's next? Like, where do you see these companies that I just mentioned, right? They have obviously grown tremendously and became staples within dealerships. What are you seeing next when it comes to that next wave of must-have tools and tech within dealerships?
Yeah, so I think that dealers should be excited that now, you know, it's going to be easier to build software, and in some cases, easier to build software yourself. So if you've struggled in the past and been concerned whether the silos around data, dealers always complain about that, whether that, you know, my software vendor isn't reactive enough and can't get me the solutions I want, all of this is going to get solved pretty quickly here, because you're going to be able to build your own software and or at least push the vendors to innovate much more quickly. On the flip side, if I'm a vendor, you know, I'm one of these legacy vendors, it's concerning, right? There's speculation out there that software as a service might go away entirely as we sort of like enter into this new AI-fueled era. And a lot of the defensible moats that someone might have had around their software might start to evaporate. It's exciting on one side. I think it'll be net, it'll be very positive for dealers. They're going to see a wave of new entrepreneurs attacking the space, providing new solutions. But I think for some of the incumbents out there, it's a little concerning when they're trying to figure out how much of a threat AI might be in general, and whether the moats that were defensible in the past will continue to be something that they can depend on.
Do you think dealers should care? Like, do dealers just benefit from this, or do dealers, have to actually, does it destroy any value within the dealership? Right? Like, how do you see this playing out and ultimately impacting dealers?
Yes. So maybe I'll defer to Sam here as the expert in-house. But, I think that I would talk out of both sides of my mouth, right? At one point, dealers should be more excited than ever. I mean, the cusp of innovation that's coming is going to be, in some ways, maybe overwhelming, right? I mean, imagine when we go to NADA, like Bernie just said, in a few months, we're going to see all sorts of AI tools, and dealers are having a hard time making sense of, like, is there any value to these things, and what should I adopt, and how should I adopt these things and internalize these with my processes? But at the same time, I think the challenge is going to be keeping up to speed on all this stuff. Like we could spend all of our time just reading the press and trying to understand. ChatGPT has just launched a new AI tool. We had news here this week about Apple's AI initiatives and what that's going to mean when AI is on every single device in all of our pockets. And I think this is going to be the challenge, is like, how do you filter out the signal from the noise, so to speak, and make sure that you're staying abreast of relevant information, but not getting overwhelmed with the sheer magnitude of, like, these press releases that are coming out. And I think that the buzz is only going to continue to build to a crescendo.
Yeah. And so, Steve, I would actually add to that one of the biggest challenges with AI in today's world is there's so much of it. It's devalued every new idea out in the marketplace because there's all these promises, and so few of the promises actually get executed on. And in automotive, I think part of what makes us successful in automotive is we're fast to execute, we're fast to produce a result. And I think a little bit that's why automotive in some areas is so resistant to AI as it completely taking over. Yossi and I've talked to many BDC directors where they're like, you know what, we still like a manual BDC because we understand it. I think these AI companies need to do better at making the promise, delivering on it, and understanding what the implications are. And then the other challenge is there's so many disparate systems still that one thing that brings them all together still remains a challenge, and fully understanding all the consequences. And I would actually ask you, in your role, looking at what are the effective AI tools, how do you break through the noise? How do you find those tools that work? And do you have any recommendations for dealers? You've created great programs in the past that have made dealers a lot of money. If I'm a dealer today, September 2025, frustrated with the AI noise, how do I break through that and find the real tools that will help me make money and deliver my best to customers?
Yeah, it's a great question. And I think about this a lot, right? It's getting harder and harder to get time and attention to folks like you, Sam. You're a busy guy. In addition to running a bunch of dealers, you're on here, and you're trying to get on your schedule to pitch you for 30 minutes is almost impossible, I'm certain.
Well, you got to come on here because this is where we all learn together. This is our Dealer 20, right? So yes.
There you go. But yeah, I think that step one is to push on your current vendors, right? So every vendor by NADA will have a new AI module. I think sit there because, as you said, Sam, that's where your data is now. Your historical transactions, your consumer data, et cetera. Find out what your existing vendors are. But then on the other side, be very open-minded. In some cases, these big vendors, and I've been there, I've worked for a number of them, are very slow to move. And these new startups can move so quickly that if there are big opportunities, big pain points that you're suffering, I think push first on your existing vendors, but then be open-minded to who's out there that might solve these things. With the caveat, as you said, Sam, is like, the data integration will continue to be an issue. And you may find a startup that's really onto something with a great founder. They've got a good value proposition for you that's solving a big pain point. But if they can't integrate back into your data, are you just going to continue to be frustrated?
Yeah. Steve, you mentioned the barriers to entry are lower for creating software. I totally agree. Yet the probability of success also seems a lot lower. And I think to the fact when I just talk to dealers off the record and they say, I'm reluctant to try another tool. I already have all these other tools. And it almost feels like common sense to me that dealers are going to continue gravitating to these connected solutions as opposed to point solutions, right? I can't have a separate chatbot and a separate CRM and a separate digital retailing tool and a separate AI. Like it's going to become too challenging. How quickly do you think that's going to happen to where we're just going to see this wave of consolidation in the industry and dealers go from using 5 AI tools for all these different departments to just one singular tool that dominates the market? Is this like a winner takes most or winner takes all situation?
I think not. I mean, I've been in the industry for a while, 25 years now, and we could have had exactly this conversation 25 years ago. And I think that you're still going to continue to see, really smart people come into the space, build really great, compelling new value propositions for dealers. They'll get acquired so that the big incumbents realize that in many cases they aren't going to be the innovators. They're going to buy innovative companies, which is going to fuel entrepreneurs. There's a lot of M&A. We talk about M&A, and you will next with John, about M&A for the dealer buy-sell market. But there's a lot of M&A that continues around these startups. And you have the big incumbents, the CDKs, the Reynolds, the Coxes, the JD Powers. And at this point, when they look at strategy, it's as much about acquisition as it is about trying to innovate something new from scratch. And it makes a ton of sense. For $20 million or $40 million, they can buy a product that's proven and not have to run the risk of trying to launch something from scratch. And by the way, take out a potential competitor that's only going to grow stronger over time.
It's also, you mentioned M&A, and I started thinking about that time where like the lines were starting to get blurred between wholesale and retail. Yeah. Right. Wholesalers and getting into like dealer to dealer transactions or whatnot. But then I think about tech, and I'm like, wow, like we're seeing this in tech as well, where the DMS platforms are integrating, payment systems and, CDK, I'm using it as a real example, like the integrated payment system and inventory analytics platform, right? First thing that comes to mind is like vAuto and stuff like that. And it's like the lines are getting blurred. These companies are, they're going up and down the funnel and saying, well, how else can we replace tools that our dealers are already using, put them all under one stack so that's an easier, just a better user experience for the customer. And everyone's doing it in different ways, but you're seeing it in manifest in many different ways. I want to slightly change topic. So again, being a former, venture backed founder myself, I think about, the power law, where there's, quote unquote alpha in our industry. And I've noticed that a lot of the big successes in this industry recently, and this might be some survivorship bias because I'm maybe not paying attention to others, but I have noticed that you're seeing a lot of big successes come out of dealer grown auto tech. Right. So some examples like Drive Centric, Busy Car, who's on a tear. I've heard VinQ's doing well, and I'm sure there's many other that I didn't mention. What's your take on just dealer grown tech? I mean, it seems to be doing well, or maybe I'm only paying attention to the ones that are doing well. Do you think that is where the alpha is in our industry? Do you think that is really the next generation of tools for dealers, literally dealers built by dealers? I mean, look at this platform, right? This is we pride ourselves in being a media platform from a dealers for dealers, right? So is that where we're headed?
Well, look, I mean, some of the VC secrets in terms of generating alpha, which for everybody out there, that's above average returns than any benchmark, like the S&P 500 or whatever, is unique insights. And unique insights can come from a bunch of different places. But I'm willing to bet that if I spent half an hour with Sam in his office and we whiteboarded, what are the biggest pain points that you've witnessed across your career that have not yet been solved? He'd probably have 5 different businesses we could literally start right away. And that's not going to come out of some kids out of Silicon Valley, right? They may come in, they may interview Sam, but unless they can get access to the right people that have the right knowledge, they're not going to really be able to tease out of that the right problems that actually need to be solved. We love when dealers are innovating. I love dealers that have said, look, 15 years ago, I identified this problem. I never had a way to solve the problem. And I've never had a vendor come up to me in 15 years to solve that problem. And now finally you're here, right? You're here with a company that's going to potentially solve that problem. That's the big unlock and the big aha to get alpha or above average returns that we kind of look for. It can come from a couple different sources. If you got an entrepreneur that partners really well in the early days with a couple of power user, really smart dealers, they can get that knowledge out of the dealer's brains and then they can go execute. But to your point, Yossi, I mean, it's also very exciting now that it's really easy to build software when you get dealers who say, look, I've waited long enough. Sam's sitting here and said, 15 years, I've been waiting for a vendor to walk in my door to solve this problem. And, Sam finally says, screw it. I'm going to go hire a developer and I'm just going to get started and build this myself. And this couldn't have happened 20 years ago because it was so expensive and time intensive to build software. So I think, like I said, I mean, we are going to see so many more dealers with the frustration seeding new entrepreneurs. And I think it's going to be a very exciting cusp of new innovation, a new wave of innovation that we're going to see in the space.
So is maybe part of the takeaway for a dealer audience watching that now is a time, maybe unlike 10, 15, 20 years ago, to find that developer and seed that idea and create that, is the entry that low on software development that if the problem is more key than having the ability to create the software on the other side?
It's even better than that, Sam. So this gentleman, I won't disclose who it is, but somebody this morning running a group, he literally has coded this himself because now this quote unquote vibe coding is so easy that you can sit there with a chatbot open on your screen and you can tell it what you want, and in real time it'll write the code, show you exactly the functionality. And he admitted, this morning, he said, look, I've had 100 iterations of this thing since January when I started. But Sam, literally, if you wanted to, by the end of this weekend, you could have a piece of software that no external developer touches, and it would work. It would integrate into your systems. If you could point it to the APIs from your software providers, and it would actually work. So I do think, and 18 months from now, it's going to be even easier and cheaper to build this stuff. So I think we are, Sam, to your point, on the cusp of a massive amount of innovation. So if you're a dealer and you had this problem that hasn't been solved by vendors that you've been sort of percolating on, has been incubating in your brain, now would be the time to start exploring this stuff.
So I'll buy it. You talk about being able to enter it into this program and it'll help create it. Where do you source the developer to solve the problem?
That's the thing. You don't need a developer any longer. Literally, the software, your ChatGPT window is effectively, it will write the code in real time as you continue to iterate and say, look, I don't like the colors in the background, or I don't like where that button is. It'll come back and say, well, what about this? and it'll be writing the code in the background. At the end of it, you take that code, you upload it, and you're ready to go. The software is live.
So
There's a
as-
couple, Sam,
Go
there's
ahead.
a couple companies that do this, like, and there's a million, but there's Replit, there's Lovable. These are like companies that you could just literally go on it and like prompt it like ChatGPT and build your own software. It's pretty incredible. Steve, I want to ask you a question about your fund. So you've raised, I believe, multiple funds. I'm an investor in the first fund.
You are. Thank you.
Yes. So two-part question. First, I want to talk to you about how your fund is doing and are you still raising capital? And then I want to move on to actual, portfolio companies. I'm curious to know, if there's any exciting outliers at the moment or anything that's particularly taking over the industry. But let's start with the first question. Are you still in fundraising mode? Do you think you're going to raise another fund? Where are you at?
Yeah, I mean, you're kind of always in fundraising mode. We're on our third fund now. We've made 10 investments out of that fund. We actually wrap up the fundraise. The final close for that is in a few weeks here, and we're going to be oversubscribed. The target was 15 million. We're going to end up just north of 18 million by the looks of it. I've still got a few LPs coming in, but yeah, I think we're off to the races here. Like I said, we've made 45 investments. To answer your second question, our standout, if I can mention by name, is WarCloud, a company you know well. You've invested in. It's going to do extremely well for you, and very very simple problem it's solving, but a problem that every dealer has, which is how do I get paid faster through my warranty reimbursements from the OEMs. And typically dealers have a clerk or a human that's doing them. And if that clerk's sick or lazy or not doing a good job, then it's a cash flow issue. So, WarCloud automates all that. The dealers get paid faster. There's never any errors. And we're showing, interestingly enough, because of errors, dealers on average make 14% more per RO. So we're looking for solutions like this that automate problems at dealerships using fairly straightforward technologies that have a demonstrable and immediate value back to dealers.
And I'll say one more thing. What I like about small funds, Sam, is that your interests are sort of aligned with the general partner. You go to these big funds, billion-dollar funds, and they're making so much on fees that it's like they don't really care if they like what they get carry, right? If you sell a company and all that, it's like they care, but it's the interests are not as aligned. And here I do enjoy smaller funds. I just think that the general partner really has an incentive to find the winners because ultimately they make money when you do, and so it does work out well. Wow, Steve, that's a great update. Appreciate it.
Of course.
Sam,
Steve Greenfield. Yeah, Steve Greenfield, general partner, Automotive Ventures. Thanks for being on the show and sharing some really cool insights with us on all things AI and VC. So thanks for being on the show,
guys. I'm honored to be here. Thanks for everything you do for the industry.
Thank you.
Yossi, it's interesting to me. One big takeaway to me, and this is big in my mind, it's the problem. It's not the technology that's the key right now. It's finding that problem that needs to be solved, because it sounds like the technology is cheap. The problem, though, really is there's so much technology out there, is getting the technology to actually deliver, I think, is also a problem.
With this technology,
companies,
as someone who's made this mistake, you don't want to build a solution and then look for a problem.
Right.
I've literally made this mistake. You need to find a problem and then build a solution, which is why even here at Car Dealership Guy, right, when we spin up new media properties or anything, it's like, why are we doing this? What problem do dealers have that we can solve by way of content, media, right, education? You have to be very focused on that specific thing, because otherwise, why are you creating something, right? Are you launching a live show just to launch a live show? No one's gonna watch it if it's not adding some value to their day. So, anyways, that was interesting.
Don't create a solution looking for a problem. So, all right, next guest up, let's turn to John Murphy, Managing Director of Strategic. Actually, we're going to hold his title for a minute, because we're going to start where he's been. John Murphy, welcome to the show.
True. Well, John, so so I asked John, we were talking about your career at B of A as an North American automotive equity analyst. You've covered a lot. You've covered the OEMs. You know a hell of a lot more than me about the OEMs. You've now transitioned to Haig Partners. Haig is a partner of Car Dealership Guys here on the platform. You're Managing Director of Strategic Advisory. So just start telling us, why did you decide to leave B of A as an analyst to come over to call it the retail side? Really, let's just start there. Why did you make that change?
Well, I kind of alluded this to before. Maybe people didn't hear me that well. The sell side is a great job. It's a great way to learn, to travel the world. Got to know a lot of investors. Got very deep in the industry, covering the automakers, suppliers, and dealers. And really, that puts me in a unique position, I think, for a lot of folks, because a lot of what's going on in any one of those links and has massive impacts in the other two. And I think really that's going to help me with the dealers, and hopefully with relationships with the automakers as well, provide a lot of value in the M&A process, but also as well as the advisory process. I went through the last couple of years. Love my job. B of A was very supportive for a very long time, but I kind of wanted to make a transition, and I spent a lot of time thinking about this because it was a great run at B of A, a really good, great run, a lot of great.
26 years
in the industry very well. It's a while. Yeah, it's been a minute. I spent a lot of time thinking about this, and I wanted to get into an entrepreneurial environment, a place where I could really make a difference, and really do that with folks that I know well, I trust. And I've been talking to Alan for a number of years. This kind of has popped up more recently and come to fruition. But know everybody in the space, and Alan is really, I think, one of the most trusted and respected folks in the industry. And I have run my franchise in a very similar way, to where you're not always necessarily right on your stock calls, but you do, hopefully very good work and really, do foundational work so that you're not just kind of making stuff up like some folks are. And I think our platforms are going to go together very well. I mean, M&A and advisory really, dovetail together. And I think we're going to, have a great run. I'm looking forward to working with him, with the team, and everybody else listening on the line here, with all the dealers. And I kind of just would say, I kind of went through this transition, like I think a lot of people do when they're kind of thinking about selling their dealerships. I was kind of exiting my old career and looking for the next thing. And, Alan was the answer as far as maximizing value, to use the tagline of Haig Partners, of what I wanted to do next. So I think I'm going to be, hopefully very helpful on the M&A side, the advisory side, and really help the whole industry in many, many ways that, a lot of other folks don't really have the perspective on.
So I'm super curious about your perspective, having come from Bank of America, having all the data, all the resources you've had, looking at the different OEMs that are out there. You're thinking about the M&A. Which OEMs do you see as being the strongest, most compelling for a buy in today's marketplace, September of 2025? And then give us 2 or 3 that are struggling, and then the potential turnaround. And, be curious your perspective on that.
Sam, you're putting me on the spot. It's real interesting. I would say just in generally in the industry, when I think about sort of the product pipeline, this year and next year are historically very low years for product introductions, right? So if you're a dealer, simply you want a lot of new, fresh product, and that's really kind of where there's kind of a hole for most folks.
Only
in
29, right? New models. It's the lowest in a long time, according to your report.
Usually we're 5 to 46. We'll recover, 3-4 years out. But a lot of companies have been waylaid by, the EV investments, right? And kind of, have been canceling a lot of those and pushing those out. So that's part of the big problem in the industry. But I would say, some of the brands that are struggling on the product development side are Nissan, Stellantis, the obvious ones. A lot of other companies, even like Toyota, have a little bit of a lull. Ford's got a little lull. Everybody's got a little lull over the next couple of years. So I think as you look 3 to 4 years out, the industry looks fairly strong on PD, product development, and intros. And I think, there's kind of this question, and I'm going to learn this in this new seat of, okay, sort of, necessarily a bad company can be a really good stock and a really good investment, and a really good company can be a bad investment in stock. So I've got to get in the weeds on the multiples and the valuations here, because I think that's what we're going to help people really uncover.
Can you explain that, John? Can you explain that? So why can a bad company be? Right? Well, why can a bad company be a good stock and vice versa?
So if you invest in a bad company and the multiple is very cheap, and hopefully there will be turnaround by the management over time, you might get ultimately the best return over time. But if you're paying a very high multiple for a good company, that good company might not be able to get much better over time. So the multiple won't expand and you won't make as much money on that investment. So sometimes buying underperforming companies or brands may get you the highest ROI. And I'll be honest, I mean, we're in the early days of joining Alan and team to understand what the valuations are on the different brands. But I think that's going to be something that holds very well, holds true to some extent, I should say, in the dealer M&A world. So we're going to be doing a lot of work on stuff that's somewhat similar to car wars and brand analysis and trying to bring sort of that understanding, to dealers where they can get the best return on their investment going forward, in addition to a lot of other things as well.
So John, you've said even in light of these fewer launches that Detroit automakers could see profitable years ahead. What's driving that profitability? And can dealers expect to trickle down on the franchise model in stores? Fewer models.
Yeah. So Sammy, it's a great question. When you look at this, they understand product development. They understand there's a little bit of a lull here. They're struggling like everybody else with the EV investments. But there are three brands or three companies that have the biggest opportunity to work on strengthening their distribution channel. So I think, if you're a dealer and you can provide value to GM, Ford, or Stellantis, I think they're going to look to partner more and more with those dealers over time. Now, this is all still, in process and still in development. But I think that, over time, the companies themselves being given a little bit of breathing room around EV specifically can lean pretty heavily into their core truck businesses. And that really, for all three companies, is where they make their money. I mean, in some cases, maybe more than all their money. They might be losing money, every place else. And they can lean into those and lean into those with the dealers. And I think the opportunity here, and this is for the whole industry, to mine and grow the parts and service business further than it's being it's being leveraged right now is a big deal. And Ford Pro is a good example of understanding some of their commercial customers and how they can really service them better and hold on to the vehicle. But the reality is dealers are capturing less than 40% of the parts and service work in years on average in the industry. And that's just money being left on the table.
John,
and there's a lot of
I got to ask though, you've been covering, OEMs for over 20 years, and you have moved over to essentially the retail side, which to me implies that you don't believe dealers will be disintermediated or anytime soon, or direct to consumer will kind of take over this industry. What gives you, as someone who came from a very objective position previously, you were not in retail, right, directly at least, what gives you that kind of vote of confidence with all the knowledge you have and everything you've seen and all the cycles in the industry, right? Like, why are you so confident in that to then literally come and be on closer to the retail side and not think that direct consumer OEMs will try to lean into that even more than they have historically?
Well, I think Alan's biggest risk of losing me is me going to be a car dealer over time, because I get involved in some of these.
Let's go. Come on over.
Even one step further. I think one step further. I really believe in this model, right? There's no kidding around.
Be careful what you wish for.
Yeah,
no
doubt.
Well, you never know. Yossi. So I think I honestly, I've, like you said, I've analyzed the industry for almost 27 years. I see where the value is really created, and I think the dealers provide far more value than the skeptics even can understand. And when I'm talking about this opportunity of getting more of the aftermarket, I mean, basically dealers capture $55 to $60 billion of the profit off of vehicles in their lifetime on an annual basis. There's about another $135 billion that goes away from these dealers, right? So when I look at this industry, I think one, you have staying power, a massive diversity in the four verticals. Two, can really increase the profitability. And one of these things in this advisory side that I really want to get after is helping dealers get after that extra $135 billion that they're not doing. And I believe that a greater partnership and collaboration with automakers can really drive that, and all boats can be lifted in a huge way. Now, I'm going to play shuttle diplomacy here, because sometimes there's not, there's no love lost between, dealers and certain brands. But I think there's a real opportunity for everybody to work to get together here and take back their fair share of these massive investments the automakers and the dealers are making that other people are siphoning away, and it's just wrong. It's just kind of wrong.
Give us
And I
a
think the
specific
customer
example of that, if
I
you
think the
would.
customer loses.
Yeah.
I'm sorry, Yossi.
And John,
us this-
and I was going to say,
Go ahead.
and it tells me also, I'd like to kind of pattern match and thing. And it also tells me that you likely believe that the industry is going to see more consolidation because you're literally and part of a firm who advises on M&A as a big chunk of what you do. And that implies consolidation. The more consolidation, the more advising that needs to be done. And so again, you're a very smart, thoughtful guy. I just have to imagine that's part of what you might see in the future. You can correct me if I'm wrong here.
No, I think you're exactly right. I believe there's power in consolidation, and the industry is going to continue to head in that direction. And whether it's 2,000 to 3,000 owners over time, or it's 100 to 200 owners of the franchises over time, I don't know. It's debatable, but it will probably be less. There'll be less owners over time. I think some folks are certainly aging out. I think there's some new pools of capital, family offices and private equity that will need to get in with operators. We all know they just can't get in naked by themselves, and maybe they shouldn't. But certainly with some good operators, and partners, there'll be a way to play. But think about this. We've got, I don't know, 17,500 dealers, maybe 18. It's in that zip code. Rooftops. Over time, that's a relatively limited number, right? That might shrink. If the D3 can, rationalize, it might grow a little bit if new brands come in, some ad points, but it's kind of a finite points of dealerships. And if I'm sitting here saying, hey, listen, I think I can help, and Haig Partners can help you grow your profits 50%, maybe more, help the automakers as well. Think about that. We've got a finite supply of points that are generating great profits as they exist right now, that we are going to get out there, and I'm going to work my tail off, to grow. That becomes something that is incredibly attractive, not just the people that own the points, but over time, people that want to get in and invest. And that will, I think, the new capital coming in might have a greater appetite for maybe giving up a little bit of near-term profit to drive long-term profit in value. So no, I firmly believe this. I firmly hope to help folks get after this. And like I said, Alan's biggest risk of losing me is that I get out there and try to do it as well. So
wait,
join the game.
So John,
go.
I gotta ask. Feel free to respond to this if you can. But if I'm a Chevy dealer, GM dealer, and I just read an article that the CEO of my company just sold 40% of her stock, what am I missing? How is that normal?
So
go ahead.
Well, I think Mayor's held a lot of stock for a significant amount of time. I certainly think that in first blush you might be like, yeah, that's certainly not necessarily a great sign. Stock is near all-time highs, or near highs since its IPO, and the stock before this has not had a great run. But Mary actually has done sort of objectively a really good job, and the profits have been relatively stable and near record highs recently. And they're buying back stock as a company pretty aggressively, which is a good strategy on cap allocation. So I think what Mary is doing right now is, what any prudent person would do is diversification of what is a fairly large, asset pool of her own in the stock. I wouldn't read into it that something is going wrong at GM or it's a sign of something about to, fall out of bed there at all. And I think Mary is pretty committed to the business. Paul Jacobson, Mark Royce, the senior management there, committed to the business. They've brought in some real new talent, some folks from the finance world that I know they're near and dear friends that I think are going to drive that business fairly well. And I think like a lot of automakers, this is one thing that I think everybody forgets about this industry. And this is a weird, wonky, analyst thing to say is, capacity in North America is capacity utilization is running around 70% right now, right? If we were kind of sitting here 10, 15, 20 years ago, you'd say the industry is collapsing, right? What's happening right now is the automakers are putting up near record profits at 70% cap U. Usually 80% cap U is where you break even. So the idea that the industry is operating at lower volumes and nobody is really jamming hard to take market share and go from 70% cap U to 90% and get out there and take a lot of market share. everybody is starting to really understand at the automaker level. I think it's a good message for the dealers that if they operate at lower levels and higher prices, they can make more money, right? I get really wonky Lagrangian profit maximization equation. I won't even get into that on the show. We can talk about that later. But they're understanding this stuff. And I think GM really gets it. And I think this focus on trucks, now that they've been sort of unburdened by CARB and some of the EV mandates, I think a lot of these companies have a pretty bright future, and I think their auto dealer partners are a really good opportunity.
And yet there still are OEMs that have stair step and are leaning heavily into it to push the volume, right? So it's still a factor in the game.
All bad actions are gone, but I think the in general is acting a lot better, Sam. I think it's fair point.
Yeah. Well, John Murphy, Managing Director, Strategic Advisory at Haig Partners. Thanks for being on the show today. Thanks for sharing your perspectives and bringing these unique insights. Wait, we got to ask, though, who takes over the Car Wars report at Bank of America? Did you ensure its continuation beyond you, or is it dead now?
We'll see, but might have something. We're doing a conference at NATO on February 3rd, where we'd love to have everybody come, where you might see something that, is sort of some brand analysis that might be, somewhat similar, but I've got some great colleagues, at Bank of America. Federico Merendi is a fantastic analyst who's working on it right now.
Incredible.
I hope to help him, but I also help everybody with some new brand analysis.
That's right.
February 3rd at NADA. Look forward to seeing everybody.
Thanks for being on the show.
Amazing.
Thanks, guys.
Thank you so much, John.
Yossi, some great conversations today, yeah?
Yeah, what a lineup of guests. That was super interesting and great topics. Really, really, really fun show.
Yeah. Well, that's a wrap on this Friday. We're back Monday. Thank you to our Daily Dealer Live audience for watching, where we break down the biggest moves in the car business. You want to say something, and go Eagles, right? Car business as they happen. Don't forget, we're here live every Monday, Wednesday, Friday. So if this is your world, hit like, subscribe, turn on those notifications so you never, ever, ever miss a beat. Go Eagles, go Bears,
Sam.
go
when I
Lions.
sent the picture to the team before we came on, Cole sent me a message. He's like, if you're gonna wear the jersey, you got to come on the show like fully inebriated as well. I was like, all right.
Well, maybe Monday I'll come on with a jersey. That's the challenge for Monday. So we'll see everybody next episode. Thanks for joining us. See you Monday.